Hello friends, how are you doing out there? This is Vijay Bambani, and in this video I want to record a game plan of mine that I would implement if, and I'm using the word if. Before you comment, just listen to the emphasis on the word if. The market was to correct deeply. I'm talking of a correction, not of a reversal, not yet. It's early days yet. I've said in my videos that I still don't think the markets are in a bubble. You can call the markets a bubble when the decline exceeds 20%. We have not yet declined that much, so any fall will only be a correction. But the correction can be significant. So, in case it does, it is better not just to expect it, but to have a game plan at hand ready. So what would I do? Feel free to disagree, of course. What would I do if at all I saw the markets correct? Where would I put my money, or more importantly, my company's money, which again becomes the shareholders' money? And why? More importantly, why? Consider this as a continuation of the video I recorded on 4th of Jan in this playlist. I think it makes sense to buy the index when the market falls, and falls significantly. As I record this video on a Wednesday morning, I'm seeing that the Nifty has fallen more than 100 points, but I don't consider this as any severe fall. This is something that the Nifty falls or rises in a matter of a few minutes on a normal trading session. So this is not what I call a serious fall, and it is not something to start worrying about. So only a fall which exceeds 500,000 points is where I would say that you need to start thinking about implementing this strategy. I would start to buy the index, and the way I would buy the index is not by buying calls or buying futures, but by buying ETFs. Now the reason why I would buy the ETF. As you know, the index is nothing but a composition of the cumulative impact of shares that make up the index, or as they are known in jargon, constituents of the index. For example, the Nifty 50 is made of 50 stocks. The BSE 30 is made of 30 stocks. So when I buy the Nifty ETF, the exchange traded fund, there will be shares of those 50 companies exactly in the same proportion as they have weightage in the index. Where do you get the weightage? I will guide you. Go to the NSE's website. Put your mouse on the product link. You will have a drop down menu. Click on indices and you will get the weightages of these indexes. And why must you look at these resources? For a simple reason that these weightages change from month to month. Now, this is where the accounting trip or the accounting jugglery makes the index or the indices go up. Why do I favor, when I'm talking of investments, not trading, by the way. For trading, I prefer individual stocks, but for investing, I would say the index, and I'm going to share the logic with you, so please bear with me. Now, why would you want to care? Because these weightages are not constant. The way the weightages have been changed around by the Index Management Committee, both at the BSE and the NSE, is if a stock rises in price, its weightage is automatically increased in the next month, and the shuffling of the weightage is done once a month at the end of the month. So on 31st March or possibly maybe on 1st of April, you will get the weightages of March. On 1st of May, you will get the weightages of April. So they are reshuffled every month. Now, if the stock is rising in price, its weightage will go up. Now, those of you who are quick thinking and know a little bit about mathematics will say, hey Vijay, that means that the stock which is heavy weighted and is rising, its weightage will go up, so the Nifty will never fall much. That's precisely my point. That's the reason why the market refuses to fall. In case you haven't understood it. Now, if you go back in time, earlier, the weightages were a lot more passive. They were not shuffled around every month, and we followed the free float market system of weightage, which of course is still there, but the shuffling has become a lot more frequent. When the Nifty or the BSE Sensex weightages were determined, the weightages were not changed so often, which is why the markets used to fall and rise much. Now that the weightages are dynamic and the companies whose share price is rising, it keeps the indices higher and stops them from falling, because falling stocks weightages automatically reduce. Now, why would I not invest in the Nifty ETF when the dice is loaded against a decline? It makes sense. Now, the reason why I say ETF rather than futures and options is, if I was to buy futures, there would be something called a cost of carry. Now, the cost of carry means rollover cost. If I was holding long positions in the month of March and I still want to go long in April, I will first square up my long positions, go long in April, and pay brokerage, execution costs, STT, etc., and of course the difference in price, which is the cost of carry or the basis. Now, this basis is something that I put up on Equity Masters Telegram channel every day. In the last expiry, the basis of the Nifty jumped by over 100 points. So the bull who was carrying forward his long position from the previous month to this month would have paid 100 rupees only in the cost difference, plus brokerage, plus STT, etc. If I was to take delivery of the ETF, it's a one-time expense and it lies in my demat account just like any equity share. And the other thing is that an ETF is like a mutual fund, but of a passively managed category fund. Now, mutual funds are of two types: active management and passive management. Active management is where the fund manager keeps buying and selling stocks very, very frequently, maybe even daily if he feels like. He might buy X stock, sell Y stock, buy A stock, sell B stock. And there the fund is incurring a lot of execution expense. But here in a passive investment, passive managed fund, you are only going to shuffle your holdings when the weightages in the Nifty change. So at the most, the fund manager will be shuffling or trading once a month and paying fewer execution costs, which is why the expense to fund ratio of passive managed funds are lower than expense to fund ratio of active managed funds. So the index ETFs are a low cost option, a delivery option, one-time expense where I can take delivery of the Nifty. Now here comes the punchline. Don't go away. I have often told you that the biggest reliable indicator in the market is of vested interest. Who has a vested interest in what? Your job as a smart thinking trader is to follow that vested interest and let the big guys impact the prices. You merely follow suit. You're riding on their coattails. No shame. If it brings you money by following somebody big enough, there is no shame in doing so. And I'm talking about the big boys, the biggest brother of them all, the government of India. 5 years ago, the assets under management of index ETFs was a mere rupees 7,000 crores. As of now, the index ETF assets under management has crossed 2 lakh crores. That's not all. Bear with me. The punchline is yet to come. Now, qualitatively speaking, look at who owns most of the index ETFs. Now, first of all, more than 60% of the index ETF has its investments in the Nifty ETF. Less than 40% is in Bank Nifty ETF. The reason is not difficult to see. The Bank Nifty is a broader based index. The Nifty 50 is a broader based index comprising of 50 stocks and therefore relatively more stable and therefore more liquid. So definitely approximately 60% of the assets in index ETFs are in Nifty 50 and less than 40% in the Bank Nifty. Now, who invests in these ETFs? And you will laugh and smile with me when I say this. The biggest investors in the index ETF, especially the Nifty ETF, is the EPFO, Employee Provident Fund Organization. These are central and state government employees whose retirement savings are invested in this ETF. I don't know about you, but I think the Sarkari Babus are smart enough to take care of their wealth and see to it that it does not erode. If these guys are putting their money on the Nifty, I think they know what to do and why. I'm not here to question them, and the amount itself is not funny. More than 2 lakh crores. So it's not pocket change that they are exactly investing here. Who else, along with the Employee Provident Fund Organization, invests here? Central government and state government employees, pension funds, some investment institutions like mutual funds, etc. And the shocking part is that only 8% of the total asset under management of index ETFs are by individual retail investors like you and me. This is so neglected by the retail guys that they are busy trying to trade in the market, make money one day, lose money the next day, come back frustrated and try again on day 3, when all they could have done was ride on the coattails of Big Brother, Mr. Government of India, which is smart enough to know that it could have doubled its money from the low of March 2020 to January, February 2021 and invested straight away in the ETF itself. So this is number 1 of my game plan when the market falls. Number 2, you all know that I talk a lot about bonds and fixed income securities. I would raise my allocations to fixed income for 2 reasons. Number 1, it takes away money from the stock market during a decline, in which case I save myself from erosion, even though it is notional and on paper, erosion in my wealth from equity. Number 2, I have a feeling that interest rates in this country, and not just in this country, but mostly in many parts of the world, will try to be subdued or forced to be lowered by the central banks of the countries, because today the biggest borrower in any geographical region is the government of that area. Because of the stimulus being given in the post-COVID pandemic, governments are big borrowers from the bond market, and they're hammering the yields so that they can borrow money at lower interest rates. So before interest rates fall any further, I would basically try to raise my stakes in the fixed income market. Where would I put money? I'm a big fan follower of sovereign debt. And sovereign debt is loans taken either by the state government or the central government. I personally favor the central government for a simple reason, that only the central government has the power to print currency. If it runs out of money to pay me for my bonds or my sovereign guaranteed other investment schemes, the government will simply print currency and keep the printing press working overtime and give me back my money. Sure enough, inflation might mean that my money can buy fewer Coca-Colas or fewer bread and fewer butter and cheese and eggs. But at least I'll have my money back rather than invest it in private mutual funds or debt funds and lose it all to the likes of Franklin Templeton. So I'm a big fan of sovereign debt, especially central government schemes. And these are the 2 things that I would do when the markets are either coming down or look like they are threatening to come down. A, index ETFs led by the by the Nifty 50 ETFs, and B, sovereign debt. On this somber note, I bid goodbye to you, not before reminding you to click like on this video if you agree with what you saw. Subscribe to my YouTube channel if you haven't already done so, and click on the bell icon to receive instant alerts about fresh videos being put up out here. in the comment section. Do let me know what you think of this video. I love hearing from you. Positive, negative, give me all kinds of feedback. And friends, a reminder, I'm coming to you on the 3rd of April, Saturday, 11 a.m. to have a live Q&A session on gold and silver. I'm sure many of you are now worried about why gold and silver are going down. So join me at 11 a.m. on 3rd April for this exciting live event. It's one of the first times that Equity Master is doing a live event on YouTube. We'd love to have you here. See you on 3rd April. Take care. Bye-bye. Thank you for watching.
Also, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.